Welcome to Mind Your Money. I'm Julie Hyman, and this is Yahoo Finance's flagship personal finance show. Think of this as your financial toolbox. For the next 30 minutes, we'll give you the latest money news, cut through the jargon, and tap into expert advice, all designed to help you take control and build a stronger, healthier financial future. On today's show, Medicare open enrollment kicks off next week. We bring you the 3 key things you need to know ahead of that important date. And many Americans are worried that the economy is slowing down. We'll lay out a few offbeat recession indicators to watch. Plus, with rates coming down, you may be thinking of jumping on the refinancing bandwagon. But finding the true cost can be confusing. We'll get you answers later in the show. The Medicare open enrollment period runs from October 15th to December 7th, and it's an important time for beneficiaries to review their benefits and their coverage. Yahoo Finance senior columnist Kerry Hannon joins me now with the top 3 things you need to know. Hi, Kerry.
Hey, Julie. Great to be here. Yes, once again, it is open enrollment season for Medicare. What's important about this is last month, everyone who's enrolled in Medicare got their annual statement, the notice of change in their plan. So whatever things were shifting around. But the truth is 7 out of 10 people just jettison this. They don't even look at them. And that's according to KFF. And so the important thing is, number one, don't do that. Examine what is changing in your plan. And number 2, once you see, where the changes are likely to be, look at what your medical needs are. What drugs, what pharmaceutical drugs are you taking? What sorts of needs do you have? And how is that going to be reflected in your coverage needs? For example, if there's a certain drug that you take, is it still covered in your plan, in your Part D plan? We can get into that a little bit later. But that's very important to know. And then look for resources. It's pretty confusing. There's no question about it. So Medicare itself has a great tool called the Plan Finder. And it's a great way you can go there. They've just spiffed it up again recently. And so it's a good place to compare plans and make sure that your needs are covered there. Also, the Medicare Right Center has a hotline that can help you. There are other resources as well, but really don't ignore it this year. This is really important. There are a lot of changes this year, and healthcare costs keep going up, so it's important to stay on top of it.
Yeah, most definitely. Okay, so as promised, you said we'll get into the Part D a little bit more. So there's changes for beneficiaries of those prescription drug plans too. What do we need to know?
Yeah, Julie, this is the big story this year. It's the Part D. So Medicare has a couple of parts. There's Part A, which covers hospital stuff, and B is your outpatient and your doctor visits, that sort of thing. But D is your prescription drug plan. And this is key. And these are where the changes are, because there's now a cap on pharmaceutical outlays that people, seniors use. And it started last year, but this year it's $2,100. There's a cap put on how much you need to spend. So if, in fact, there is that cap, what has happened is insurers, because this Part D prescription drug plans are run by private insurers, and they're getting, as this comes into play, they're moving expensive drugs into other tiers so that your particular pharmaceutical drug may no longer be covered in your plan, and so it will cost you more. And if it is not covered in your plan, you're going to pay the full price of it. So this is where the big thing. Also in Part D, we're seeing that most plans are going to have a deductible this year, only 85% last year, and the experts I talked to expect that to ramp up, and that deductible could be as high as $615, and premiums are on the rise as well. And so by premium, some may have zero, but it could be up to $100 in monthly premiums. And so it all depends on your plan and where you live. It all comes down to do your research. This is more important than ever as healthcare costs are rising.
Yes, a great mantra on a great many different topics, especially this one. Kerry, thank you.
Thanks.
And for much more coverage, you can tune in to Decoding Retirement's Medicare Annual Enrollment Series. That starts Monday, October 13th and runs through Friday, October 17th. Americans are souring on the economy with consumer confidence near record lows. The share of consumers who think a recession is coming in the next year rising to the highest level since May. A recession, as defined by the National Bureau of Economic Research, is a significant decline in economic activity that is spread across the economy and lasts more than a few months. Collecting that data takes a while, and with the government shut down, reports are not being released from that source right now. So we want to look at some less than traditional measures to watch. Joining me now for that, Yahoo Finance personal finance reporter Emma Ackerman. Hi, Emma.
Hi.
So where should we be looking? Usually we rely on the government for this stuff, but we also rely on a lot of other different sources. So where should we be looking?
Of course. So there are some goofy and some less goofy sort of offbeat recession indicators that economists like to take a look at. One of the more reliable ones, or one of the more trustworthy ones, I would say, being cardboard box demand. Essentially everything that we want or need comes to us or comes to the place we buy it from in a cardboard box. And it can sort of be an indicator of consumer spending and how strong that's looking. Famously, it was something that Alan Greenspan like to take a look at. That being said, consumer spending right now is pretty strong, but there are some warning signs that things could cool off if you take a look at cardboard box production. We've seen cardboard box makers cut back on production recently. We've even seen a few mills close this year, and some of the steepest cuts since the Great Recession, actually. And one economist I spoke to noted that this is especially interesting right now, given that this slowdown is happening right before the holiday shopping season, when we would sort of expect things to ramp up.
Interesting. Okay, so that is a more serious indicator. Now I'm going to go to one I think is less serious, and this one's been around for a while, the hemline indicator. In other words, that where women's skirts are trending is an indicator of the economy, right?
Yeah, so I'm a fashion person. I care about fashion history. So this one is particularly interesting to me. It's also just not true, right?
Come on.
Like, it is true that fashion can get more conservative in times of an economic slowdown. Palettes may get more neutral. People may buy less. Makes sense, right? But when it comes to hemlines, like the idea that skirts get shorter in times where the economy is doing well, and skirts get longer when it's not doing well, that's just doesn't hold up. Like right now we're seeing that mini skirts are trending, right? Harkening back to Y2K, which is when we also had a recession, right, with the dot-com bubble bursting. And longer skirts were trending pre-pandemic, when the economy was doing pretty well.
Maybe it's a contrarian indicator. I don't know. We'll get to think more about this. And then sticking sort of fashion adjacent, the lipstick index is something else that folks talk about, or lipstick indicator, I guess.
Right. I think that this can hold a little bit of weight, but it's perhaps more complicated than just lipstick. And so this theory came from like post-2001, I think it was the CEO of Estee Lauder who said that essentially when the economy is in trouble, women buy lipstick as a little pick-me-up. Of course, people buy a lot of little things as a pick-me-up, whether that's lipstick, coffee, Labubus, which some people have thought like those keychains may be a sign of a recession. But ultimately, what is a better indicator is restaurant traffic, which that could be considered a little treat. When we start to see people cut back on eating out, that could be a sign that they're tightening their purse strings, and we have seen that restaurant traffic has slowed a bit.
And then finally, and this one, admittedly, I had never thought to think of this, we're in Halloween season, spooky season. Those big skeletons that I see on my neighbors' lawns, that's an indicator?
So this one came to me, and again, I was looking for sort of like fun pop culture indicators. This one came to me from a state legislator in Iowa who had sort of theorized to his constituents that maybe this could suggest an economic slowdown. He himself is a fan of Halloween decorations, and so he keeps an eye on how those big skeletons, which are called skelly, are faring, and he checked out when they started going up for sale, were they selling out? Because they had in prior years. He found that they were not. Of course, this could mean this could have multiple explanations, one being that they could have just made more skeletons, or everybody may already have their fill of skeletons and doesn't need another one. But one thing that what did strike me as interesting is he pointed me toward a Facebook group for other fans of Halloween decorations, and people were saying in the comments there that they were pulling back on Halloween spending just because things were a bit tighter this year. And of note, I did check to see if those giant skeletons were still in stock this morning, and they are.
Well, I just did a quick search to see how much they cost, Seems like there's a pretty big range depending on whether the eyes light up or they have different features, but we're talking like in the 100s up into the multiple hundreds of dollars. So.
Right. So this is, I mean, it's still a luxury product, right?
Yes.
The legislator that I spoke to, what he had said is this is sort of a thing where it's like, it suggests you have excess money to throw around to make your kids happy. Like same thing as like, taking your kids to a theme park for a day, maybe not, if you have to include like flights and hotel and stuff like that. Right. But it might be the sort of thing where if you can buy it to make your kids happy, we're seeing less of that.
Interesting. There's one Skelly in my town that the people dress up, it stays up year round. Gets a back to school makeover, gets like a spring makeover. It's fun.
Maybe they could sell these year round.
Maybe that's an opportunity, right? Emma, thank you so much. Well, stubborn inflation is making it harder and harder to cover necessary expenses, let alone save for the future. Many financial advisors suggest reverse budgeting to help make ends meet. Joining me, Casey Bond, personal finance banking editor. So, Casey, what do we mean when we say reverse budgeting?
Right. Well, with a traditional budget, you basically list out all of your expenses, allocate how much you can put toward each one, and then whatever you have left over is what you put toward saving. So with a reverse budget, you do just that. You reverse your priorities so that you put money toward saving first, and then whatever you have left over is what you put toward your expenses. It's also referred to the pay yourself first method.
And so how do you start? Where do you go from if you want to do this?
Well, if you want to start a reverse budget, the first thing you need to do is audit your spending. So take a look at the last few months of bank statements and credit card statements just to get a handle on how you have things far. Then you want to set some clear savings goals, whether that's saving more for retirement, building an emergency fund, holiday travel, whatever it is. Having a clear objective in mind will help you make that a line item in your budget to put money toward. After that, you want to calculate how much money you can actually put towards savings. So that might mean adjusting some of your spending a bit. And if you're just starting out with reverse budgeting, you may want to be conservative. Start with a smaller amount of your paycheck, 5%, 10%. See how it goes for a couple of months and adjust from there. Then automating contributions can also help. It prevents you from spending money on other things rather than put it toward your savings, just helps you be consistent. And always keep in mind that you can be flexible. So, as your priorities change, as your income may change, you may need to adjust that budget. So check in every quarter, 6 months, make sure it's still working for you. If it's not adjustments, or even try a different type of budget.
Okay, thanks so much, Casey. Appreciate it. Coming up, the cost of refinancing your mortgage, plus our weekly segment, Ask Yahoo Finance Anything. It's after the break on Mind Your Money. According to the National Mortgage Bankers Association, mortgage refinancing demand fell 8% in the week of October 3rd. Here with more on why the refinancing demand is tapering off, Yahoo Finance senior housing reporter Claire Boston. And Claire, this is a number that tends to be volatile, right? It bounces around a lot. But why did we see that latest trend?
Definitely, Julie. So right now, I think we are kind of at the tail end of a refinancing wave that we have ridden for the past month or so. Mortgage rates took their big leg down from 6.7 to 6.3% about a month ago. And so there's been a lot of refinancing action from those people who had those 7% mortgages. Those people, generally speaking, if they wanted to refi, they probably already did it. That being said, we're still pretty much near year-to-date lows in mortgages right now. So I am curious if anyone maybe kind of missed that wave, if they will come back now, but we'll have to see.
And just like with mortgages, do refinancings pretty much follow rates? In other words, we've seen rates kind of tick up a little bit. Is that why we've been seeing some weakness?
Yeah, that could definitely be part of the issue. You want to make sure that you're in the money with that refinance, and you're going to have rate savings that make sense to actually go ahead and pay those fees associated with refinancing. And mortgage rates have kind of been up and down in recent weeks, and so those few basis points can make a difference here.
And when you look at the year over year instead of the weekly trend, we're still up double digits. So we've still seen an increase in refinancing versus a year ago. What does this kind of tell us overall about the housing market?
Yeah, generally speaking, the fact that we see more refis now are probably a good sign. The mortgage market in general has been just so slow, along with the whole housing market. People are not really buying homes, and a lot of people have not been buying homes for years. And so as a result, a lot of people have not needed to refinance. But this is kind of a testament to the fact that rates have fallen quite a bit. We are at around the lowest level, since about a year ago. And so that is like a little bit of good news for consumers here. Depending on where your rate is, if you have a 7.5% rate at 6.3, you could certainly be in the money for a refi, and we do have those people out there.
And the trends that drive refinancing, is that substantially different from what drives mortgage, original mortgages?
A little bit. One thing about refis is that you're already in your house. You've already made your purchase. So you feel probably pretty okay about where you are. One thing that on the purchase side we really see a lot of is people are very sensitive to what's going on in the economy. We just had Emma on earlier talking about potential, weakness indicators here. And this is a moment where people feel pretty scared. And also right now with the government shutdown, people who work for the federal government and are furloughed really can't be buying a home right now. And so as a result, this is a moment where a lot of people don't really want to take that plunge and buy a house now. But if you've already got one and you might save some money with a refi, that might make sense for you.
That does make sense. Thanks so much, Claire. Appreciate
Thanks,
it.
Julie.
And you can scan the QR code below for all of Yahoo Finance's mortgage coverage. Well, refinancing a mortgage allows a homeowner to trade in their existing loan for a new one with better terms, like a lower principal, interest rate, or monthly payment. But there is a cost to refinancing. Here to break down what homeowners can expect to pay, Yahoo Finance personal finance editor Laura Grace Tarpley. So Laura Grace, what are some of the closing costs that people have to be aware of with refinancing?
Hi, Julie. Yeah, so like you just said, when you refinance your mortgage, what you're actually doing is replacing your original mortgage with a new one, which means that you do have to pay closing costs again. Refinance closing costs typically come to about 2 to 6% of the loan amount, which means if you're taking out a $400,000 loan, you can expect to pay roughly $8,000 to $24,000 in closing costs. And those can cover a variety of things from your application fee to a home appraisal, because when you refinance, you do have to get a home appraisal again to get the updated value of your home. Also, because you're taking out a new mortgage, you do have to open a new escrow account. And this is the account where you keep money for things like your homeowner's insurance and your property taxes. Depending on your lender, they may require you to put 1 to 2 months of homeowners insurance and property tax money into this new escrow account, along with what you're moving over from your old one. So that's an expense you should be prepared for.
And what are some of the factors that affect that cost of refinancing?
Yeah, the most obvious one is probably the loan amount, how much you're borrowing. For example, if the lender charges a 1% origination fee, 1% of $500,000 is going to be more than 1% of $400,000. Another one is location. Your local government can play a part in what you pay in closing costs. For example, property taxes vary depending on where you live. You'll also pay recording fees, which is the fee that covers putting your loan details and documents into the public record, and that varies depending on your state or local government. Another one is your credit score, and I'll get into this a little bit more, but generally, like, the higher your credit score or the better your overall finances, the better terms a lender may offer you. Another one is your home equity. If you refinance into a conventional loan and you don't have 20% equity in your home, you will have to pay for private mortgage insurance, which you could pay for at closing, you could pay for it monthly. And then if you are refinancing and you have more than 20% of home equity, then you don't have to worry about that cost. Finally, the lender and something called mortgage lender fees. There are some closing costs that are just inevitable, such as a home appraisal. You're going to have that done. But there are also ones called mortgage lender fees that is money that goes to the lender, like the application fee, the underwriting or origination fee. And every lender charges different fees for this. So one might charge a lower origination fee than another. One might just not charge an application fee at all. So the lender you choose will also play a role in how much you pay in closing costs.
And do you have any control over these costs? Are there any ways to lower them?
Yeah, absolutely. There are certain things that you can do. Going back to that credit score, you can work on improving that by making sure you're making all of your bill payments on time and paying down debt. Because once again, the stronger your financial profile, the better terms a lender tends to offer you. You should also compare mortgage refinance rates among different lenders. So you can refinance with the same lender you used for your original mortgage, but you don't have to. So it's good to compare 3 or 4 different companies to see which ones offer the lowest refinance rates, which ones offer the lowest mortgage lender fees, and see which will offer you the best combination of those. Another one is that you can negotiate on closing costs, especially if you have a high credit score and good income or good debt to income ratio. This makes you like a prime candidate for a loan from a mortgage lender, and that can give you more bargaining power. So you might ask, hey, can you waive the application for me, or can you lower this other mortgage lender fee for me? And I give you more legwork there. And finally, you can consider a no closing cost refinance. There is a type of refinance where you don't have to pay closing costs, but there is a catch. So you don't pay the closing costs up front, but you add it to your loan. It gets rolled into your mortgage balance, into your principal. And so will pay interest on it. Your monthly payment will be a little bit higher. You will pay more interest over the life of your loan. So it saves you money in the short term, but you will pay more in the long term. So it's just up to you which of those is more important.
Laura Grace, thanks so much.
Thank you, Julie.
It's now time for Ask Yahoo Finance Anything, where we answer your personal finance questions. Joining me now, Yahoo Finance senior columnist Kerry Hannon. And she's got questions all related to her new book, Retirement Bites, a Gen X guide to securing your financial future. Kerry, let's kick things off right with the first question. I'm 50. How do I find my magic retirement number to retire how I want? How much money will I need to have saved? This is a great question, Kerry. How do people plan for this?
It is a super question, and it would be so awesome if there was only one answer. The problem is there's not. Of the Gen Xers I talked to for the book, about a quarter of them said they thought maybe $2 million would be the right amount of money, that magic number for them to retire. But you know what, Julie? They're guessing. Most people do not take the time to actually run the numbers, as we call it. And so, you need to grab a retirement calculator. There are a lot of really great ones out there. AARP has one, Schwab. Most of the financial services companies have these. And they're only as good as the numbers you input into these calculators. But you're looking at everything from, what are your retirement savings? What are your savings outside of retirement? What do you expect from Social Security? There's lots of different retirement income sources that you need to think about, and where you live, what your health is, how long you're going to live. I mean, it's a lot of information, but you need to take the time to do it. One quick way to think about it, though, often I hear financial advisors say, think about having 10 times your annual salary when you're age 67 as a good number to kind of float around in your head. That's how much you might want to have saved. If you're a globetrotter, you might need 12 times your annual income at 67 is the rough age, but you could say 65. That's what I'd play around with, but there is no magic number. I'll tell you that. It's always going to be shifting.
Okay, no easy answer for that one. Another viewer question says, I'm still in my 40s and wondering, how should I think about Social Security?
Yikes. This is hot button, right?
Yeah.
I mean, Social Security is problematic. I mean, there's a lot of stress and fretting and anxiety. Is it going to be here? Most financial advisors I spoke to, when specifically looking at the Gen Xers, which are, 44 to 60 in age range, they run their scenarios for them actually taking Social Security out of the equation altogether, so that they're looking at their financial future without it. But in reality, and then they also may run it with, if there's a cut in the benefit by 20% or something, which is maybe possible, in my gut, I think Social Security is going to be there for you. But again, it's probably wise to run your numbers thinking if it might be a little less than you anticipated. But my gut sense it will be there for you.
Yes, but if you plan without it, then it's just a bonus, which is a good way to think about it, probably. Here's our next question. I turn 60 soon, and I'm starting to think about retirement. What's the biggest expense in retirement?
Health is wealth. How many times do we have to hear that? The truth is, and most of the research I see and the people I've talked to, the retirees, healthcare is the one that comes up and bites them. That's the one they don't really think is going to be such a huge expenditure for them, but it truly is. I mean, yes, you're going to have your housing, you're going to have transportation expenses, all that kind of stuff. But the health is the big knuckle. I mean, that's the big, sort of tamale, so to speak. So what you need to do is Fidelity runs a number every year, and this year's number, 2025's number that they estimate that someone who retired at age 65 this year would need $172,500 out of pocket. This is after Medicare, all of that sort of thing. Out of pocket is what they would spend on their medical care for the rest of their life. So this is going to be a big nut. So focus on it. Anything you can do to get healthy today, stay fit, stay healthy. This is going to make a difference as you age, because healthcare is going to be, the costs just keep rising.
And it's probably going to be backloaded. In other words, it could potentially be towards the end of your retirement. So you got to make sure you sort of parse it out.
Yeah, Julie, those last couple years are really the killers. That's exactly when people start to have these costs that they hadn't planned for, assisted living care, that kind of thing. So it really is something you need to start focusing on it and have these discussions early.
Right. Kerry, great as always to catch up with you. Thank you.
Thanks, Julie.
That's it for Mind Your Money. Scan the QR code below to sign up for the Mind Your Money newsletter, and stay tuned for Market Domination. That's next.